somebody who is in the highest income tax bracket, right? 33%. And
Yes.
he wants to put money in an FD.
Hello, everyone, and welcome to our channel, The Mutual Fund Guys, where we only talk about mutual funds. I'm Samir Gilani, and across is Mahesh Bhagwat. Both Mahesh and I are partners at AMS Investments. We are a mutual fund distributor based out of Mumbai with an office in Dubai, where I stay. And we manage mutual fund portfolios for about 100 plus clients. Having said that, let's dive in straight to today's topic. Today, we're going to talk about debt funds and why are they important for certain kinds of investors. We had an earlier video explaining the nuances of debt funds, what exactly is debt, what exactly are debt funds, the categories of different debt funds. And we explained that as well. So you can actually click the link below in the description and you can look at that previous video. Today, we are going to talk about debt funds, and there has been a few changes regarding debt funds in the last 1 year. In the budget of 2023, there was a change in how debt funds are taxed. And Mahesh will explain to you how they were taxed before and how they're taxed now. And because of this taxation change, some of the benefits that debt funds had have now been eliminated. But even after the elimination of those advantages, there are certain reasons why investors would want to invest in debt funds. So, Mahesh, maybe you can start off by saying what were the advantages of debt funds versus fixed deposits or other kind of instruments, and what changed post 2023?
Correct. Big change happened, and we talk what you have said that, and that is that before 2023 budget, debt funds had this incredible tax advantage, right? And that was that the cost of the purchase of the debt fund would go up by the amount of inflation in the country, as long as you held it for 3 years or more. So your cost price would go up by the amount of inflation. So the total profit that would be calculated when you sold the debt fund would be based on the fact that you sold it at a certain level, but your cost has now got inflated for the amount of time you have held, as long as it has been held for at least 3 years. So the total profit, while you might have got a profit of say 110 at which you sold and 100 at which you purchased, so that would have been a 10 rupees profit in real terms for you. But when the income tax would calculate the profit, it would actually inflate the cost of 100 to the current cost levels, right? So the profit would be much lower than the 10 rupees that you are really seeing. And on that reduced profit, you would pay a tax of 20%.
Reduced
tax. So that is something called the indexation. So the cost going up of your purchase is called indexation. And for 3 years, if you held, that indexation benefits were available to you as an investor. And this was very important, which is why a lot of people would invest in debt funds, because the net of tax advantage that debt funds provided were even better than investing in a bank FD. Or a company FD, where you had to pay full tax. So this was one of the huge advantages that debt funds had. But 2023 has plugged that loophole. So there is no longer that advantage.
So just to summarize, before 2023, if you bought a debt fund, let's say at a cost of 100 rupees was the net asset value, the NAV of that fund, let's say any fund, any fund.
Yeah.
And you held that fund for 3 years, and now the NAV is at 110. Okay, so 110. So you have made a profit of 10 rupees. But because of the indexation benefits that we discussed, your actual cost price is not 100. It's say 105. It's just a number to give. So your profit has now gone from 10 rupees, okay, to 5 rupees for the purpose of taxation. So you only taxed at that 5 rupees and not that 10 rupees. And now you're saying that post 2023, the indexation benefits that were being offered to debt funds is now being taken out. So today they are at par, with other debt instruments such as fixed deposits of banks, right? And there's no tax advantage when you compare a fixed deposit or a debt mutual fund.
That is right. There is no, so the reason to invest in debt funds is no longer the tax advantage that it provides. So you now have to have genuine reasons why you would want to invest in a debt fund. And that is what we should be talking about
Okay.
today, what are the cases under which, or the conditions under which somebody might want to invest in a debt fund today, right?
Correct.
So maybe if you think about it, the first case that comes to mind is that if you have a lot of money in your savings bank account, right? What is the kind of rate that you get? You
Yeah.
probably earn 3.5%. Maybe
In
some
after
banks give
4%.
four.
Yes,
Yeah,
4%.
maybe 3.5
Yeah.
to 4 is the number that you get as interest in the savings bank account. But a
Yes.
liquid fund, which is to a large extent risk-free,
Yes.
is giving you today around 5.5 to 6% kind of
Yes.
returns, right? So a 6% return in a liquid fund vis-a-vis 3.5 in the savings bank account, there is a clear case to be made why some of the money can be moved to liquid fund instead of keeping it in the savings bank account. That is one of the reasons why you would want to invest in a debt fund, especially the short end category, the liquid fund category. What else could you think of? Somebody who is in the highest income tax bracket, right? 33%. And
Yes.
he wants to put money in an FD, which today, even a 5-year FD in, say, a private sector bank might give you around 7.25% rate of interest. And at
Right.
the highest tax rate, your post-tax returns are around 5%, slightly
5%.
lower, but around that, right? So if you, however, invest in an arbitrage fund
Yes.
today, it will give you around 5.5% gross returns. And because arbitrage funds are taxed as equity
Equity
by the
funds.
income tax, you will actually get a net of tax return of 5%. Now, it sounds
Yes.
not very different from what the bank FD gives, but you have to remember that the arbitrage funds are taxed only when you sell. So there
Yeah.
is no accrued income, etc., where you have to pay tax. But in a bank FD, you have to pay tax every year, right? Whether you
Yes.
earn the money or not, you have to pay tax. So that is the reason why you might want to put it in an arbitrage fund.
Fund.
And also the fact that you could sell anytime. Whereas a bank FD, if you book a 5-year FD and sell it in 2 years, there is a certain reduction in the interest that they would pay you, or there might be a penalty, etc. Those things are not there in arbitrage.
And I think just for the sake of the viewers, equity arbitrage funds, although they're called equity arbitrage funds and they sound like they are equity oriented funds, they actually give you returns more of a debt fund would give, because in equity arbitrage, we don't want to get into the process of how arbitrage is done, but generally it's around the prevailing interest rate in the country at that point in time.
Liquid fund rates
Liquid
or
fund.
short-term rates, slightly lower than that, but around that, yeah.
But the interesting thing is that because they invest in equity and they have almost 100% of the assets in equity, they are termed as equity funds. And in equity funds, the taxation is 15% short term and 10% for long term gains.
Yeah.
So you basically get a slightly better post tax returns of that 5% versus an FD. Second thing for investing, I think not for second, but one of the other uh, reasons why we can invest in a debt fund is that sometimes in bank FDs, you need to be invested for 2 years. Some FDs are only there for like 1 year, you have to be there. Otherwise, there's a small penalty, or they reduce the interest rate or something like that, or you need to have 2 years or 3 years. There's different categories of fixed deposits which you have to be invested in. So if you have an emergency and you need to withdraw that money, you will have to pay some penalty, etc. In a liquid fund, there is no such penalty. There is a small expense ratio, which is quite small, but it is not comparable to the penalty that you would pay for a fixed deposit. So
Yeah.
there is a convenience factor in a liquid debt fund versus an FD, more in terms of convenience. The returns are obviously slightly better, but even in terms of convenience, a liquid fund you can easily enter and exit as you see please, as per your economic situation. So I think although debt funds have lost a lot of that sheen because of that taxation event that happened in 2023, there are still some use cases for debt at this point in time. And we've mentioned a few of them.
Yeah, and there's one other important reason why somebody might want to invest in a debt fund, and that is if somebody has the smarts or somebody believes that the interest rates in the country are going down, right? Because we all know that if interest rates fall, then the NAVs of debt funds go up, right? So
Yeah.
there is a direct, indirect relationship, correlation
Yeah.
between interest rates and the NAV of debt funds. So therefore, if you believe now, it's not my job to say that I think interest rates will fall, but if an investor really believes that the interest rates will fall in the next couple of years, then one of the best ways to make money out of that belief is to invest in
Yes.
a long dated bond fund, because the long
Yeah.
dated bond funds move faster when the interest rates go up and down. So if you're expecting it to fall, in fact, long dated bond funds have been known to give short term returns of around 11-12%,
Yes.
in a falling interest rate scenario. So if that is one of the reasons one could invest. So there, if you think it is falling, then why not put some of your money in a long dated bond fund and get benefited by that? But that has to be a tactical call. It can't be a long-term investment. So it's more like a short-term play.
Yeah, I mean, just to summarize, it's for investors who have very good clue of have a clue of the economy, right? I mean, there are various moving parts in an economy. Interest rates is one of them. If you have the understanding of how economics work and you believe that the interest rates from here will begin to decline significantly, then investing in a long-term or long-dated bond fund will make you good returns. But again, it might be a short-lived event, or it might not transpire. So it's something that you have to be completely sure about while investing in that debt fund. But I also feel that of course, the advantages of debt fund are there for many investors. But yes, the advantages that were there before 2023 were far more because of the taxation benefit that the investor had. Okay, is there any other, Mahesh, any other investor you think might benefit from a debt fund?
That I can think of. So let's just summarize. What did we discuss? We said, one, somebody who has a lot of money in the savings bank account, why not move a part of it into liquid or money market funds, right? And two, if you have money in a fixed deposit in a bank, then why not put little of it in arbitrage funds? Because post-tax, you might be benefited far more by doing that. And I think third is the tactical call that you can take if you believe that the inflation is coming down, etc. I think in mota, as we say, these are the three kind of reasons why people would want to invest in a debt fund.
Yeah, and the fourth most obvious reason to invest in a debt fund is that you are completely against equity investing. You don't want to invest in any equity in your life, and you want to stick to debt or interest as your means of livelihood or wealth generation. That's also fine. So if you are there, I know, I mean, I wouldn't say the older generation, but there are people who are extremely risk averse. They don't want to take any equity risk at all. And they rather just take the risk of the debt, which is the person who's issuing it, the company that's issuing it. And fixed deposits or liquid funds are a great place for them to park their money. So that's the fourth category, the last category, I would say.
But
and it's
that would not be something that we would really advise people into getting.
We would not advise people to do all that, but I think some people are so risk averse that they tend to want to just stick to the basics or just get the minimum amount of money that they could get through a risk-free or quasi-risk-free instrument, which is fixed deposit or a liquid fund. Anyways, thank you for watching. As always, you are welcome to write to us at hello@amsinvestments.net. Mahesh and I would be happy to also do a free consultation for you if you have an existing mutual fund portfolio, or if you're looking to get your feet wet in the mutual fund industry. So thanks for watching, and we'll be back with another video very soon. Thank you. Bye-bye.